The warning signs were right there, buried on page 212 of Enron's annual filing in 2000. Anyone who read it carefully could have seen the collapse coming. Most investors never open a 10K. They watch CNBC. They scroll Twitter. They read headlines and call it research. But Warren Buffett? He reads thousands of these every year. 500 pages, dense legal language, footnotes that go on forever. He once said the 10K is the closest thing investors have to a truth serum. Here's why. The truth about a business lives in its 10K. Not in the glossy annual report. Not in the press release. Not in the earnings call. Today, I'll show you the 4 sections that actually matter. The ones professional investors zero in on. And the one place where the most important information is almost always hidden in plain sight. A 10K is the annual report a public company files with the SEC. By law. Every single year. It's not a marketing document. It's a legal one. Companies can get sued by the SEC for misleading statements in here. So the language is careful, precise, and often revealing. Most investors confuse the 10K with the glossy annual report. They're not the same. The glossy one has photos of smiling employees and CEO letters about transforming the future. The 10K has the receipts. Here's the kicker. The full 10K is free. Anyone can pull it up on the SEC's website in under 30 seconds. Yet 99% of investors never read one. Now, here's where it gets interesting. Inside that 500-page document, only 4 sections really matter. Item 1 tells you what the company actually does. Sounds obvious. It isn't. Take Apple. In its 2024 10K, Apple reported $391 billion in revenue. Looks like a tech giant. But dig into item 1, and you find that $201 billion of that, 51%, came from one product. The iPhone. So when you buy Apple stock, you're really buying an iPhone company with a services side hustle. That changes everything about how you value it. Then comes item 1A, risk factors. This is where the company is legally required to tell you what could destroy them. Most investors skim it. Buffett reads it twice. And here's the trick the pros use: compare this year's risk factors to last year's. New risks tell you what management is suddenly worried about. When a software company adds regulatory action as a new risk factor, pay attention. When a bank quietly inserts liquidity into the list, pay closer attention. This is the section called Management's Discussion and Analysis. The MD&A. Think of it like this. The financial statements show you what happened. The MD&A is management explaining why. This is where you find out if revenue grew because of price increases, new customers, or a one-time deal. Whether margins shrunk because of inflation, competition, or bad management decisions. Read the MD&A side by side with last year's. Watch for tone shifts. When a CEO who used to write strong demand across all segments suddenly writes demand normalized in certain channels, something changed. Buffett's famous annual letter to Berkshire shareholders? It's basically a masterclass in writing an honest MD&A. He tells you what worked, what didn't, what he got wrong. Most CEOs aren't that candid. But the MD&A is where you find out if they're trying to be. And then, we get to where the bodies are buried. Item 8 contains the financial statements. Income statement. Balance sheet. Cash flow. But the numbers themselves aren't the most important part. The footnotes are. Buffett has said, if you have to read the footnotes to understand a financial statement, be very, very wary. Here's why he says that. In 2000, Enron filed its 10K. On the surface, the numbers looked spectacular. Revenue over $100 billion. Earnings up. Stock at $90. But buried in Note 16, related party transactions, Enron disclosed dealings with partnerships called LJM. The language was deliberately confusing. The dollar amounts were enormous. And the partnerships were run by Enron's own CFO. That single footnote was the entire fraud, hiding in legal language. 8 months later, Enron was bankrupt. Lehman Brothers did the same thing in 2008. They had a technique called Repo 105, a way to make their balance sheet look healthier than it was. It was disclosed. Technically. In the footnotes. Almost no one caught it, until the bankruptcy examiner spelled it out 2 years later. The lesson? Footnotes are where companies tell the truth they don't want anyone to read. A 10K isn't bedtime reading. It's the closest thing investors have to a truth serum. Companies have to disclose. They might bury it. They might soften it. They might wrap it in language designed to put you to sleep. But it has to be there. So when you're considering an investment, do this. Skip the YouTube hot takes. Skip the analyst price targets. Pull up the 10K, read item 1. Compare the risk factors to last year. Read the MD&A like it's a story. And then, read every single footnote. That's the difference between speculating on a ticker and actually understanding a business. Have you ever read a full 10K? Drop the company name in the comments. I'm genuinely curious what you found in there. And if this changed how you think about doing research, hit subscribe. Tomorrow, we're tackling something a little controversial: why most index investors are quietly making a huge mistake without realizing it. Until then, read the footnotes.